Ladies and gentlemen, my name is Greg Michalowski from ForexLive.com. This report is for the week of September 22nd. It's a technical preview of the euro versus US dollar. It's now or never for that currency pair. It's time for a move. Now, I know what some of you are probably thinking, Greg, we just had one of the more news-filled weeks that we've ever had in history for the Forex market, for the markets in general. And the euro versus US dollar has been in about 160 pips over the last 11 trading days. What makes you think that next week, when we have durable goods, existing home sales, new home sales in the US, and virtually nothing coming out of Europe? Now, Draghi is speaking on Monday, so that's going to be of interest to the market, especially after the failure of the TLTRO program. But barring that, the news next week doesn't really compare to what we just went through in this week's trading. So why should we expect the market, which has been non-trending, to trend or move away or break out or however you want to term it? And the reason is because the market's been non-trending for the last 11 trading days. You see, folks, no one makes money when the market non-trends, okay? When the market goes this, that, and the other, the big boys aren't making money, and the little guys are, we may be good at buying lows and selling highs, so maybe we're making a few bucks. But really, the real money is made in the trending markets. And if the market's non-trending, no one's making money. So we got to anticipate that perhaps the market is going to trend. That we're not going to stay in a 160 pip trading range forever and ever. Amen. Okay, it's not going to happen. No one's going to make any money there. And so that's when I look for the market to move. And I don't need news, okay? They'll write the news will happen, whatever it is. I don't have a crystal ball that says, this is going to be the news, and no one does. That's going to cause the market to move, but something's going to cause it to move. And it may just be those damn technicals that Greg talks about all the time. It may just be a break out of the red zone here. Now, this is a euro versus a US dollar, and I got a little bit carried away with my crayons this week, looking at or defining what I thought was bullish, neutral, and the red zone, or bearish. And it all centers around the neutral zone, okay? The neutral zone is where the market either moves to the upside or moves to the downside, away from the neutral zone. It's a point of deflection or reflection. Imagine if I put a mirror up and it bounces off this mirror right here, like a laser, boom, 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 bounces off. If you just look at this chart and you just look at all the lows that we had here, we had a low here, we had a lows here, right here, we had a low right here, we fell below that yellow zone right here for one bar, and then we had a low here, we moved higher, we had a low here, and moved higher, and then we had lows here, low here, low here, low here, low here, low here, low here, high here, and a bunch of lows right here, but didn't go anywhere there. We'll talk about that a little bit later. But you can see that when we enter the yellow zone, it doesn't really trade a lot, does it? It just kind of reflects, or deflects, or whatever, however you want to term it. And that's a point of energy. And if you know where the point of energy is, where it's either going to deflect and move to the upside or move to the downside, then that is a real cool clue. That is a clue for you as a trader to determine bullish above, bearish below. And so as this developed this week, and I start to look at it and start to unblur my eyes and look at it, I got my crayons out and started to draw the colors. All right, and it makes sense to me. But an interesting thing happened over the last couple days. And that is, you see this blue line and the green line right here. This represents our 100 and 200 hour moving average. Now, yesterday we made a big, huge move to the downside, got in the red zone, and we actually went below the lowest low over the last 11 days, and that market failed. Typically, I would have thought, well, we failed down here. It wouldn't be surprising to go all the way back up to the highs here, through the yellow zone, all the way up through the 100 and 200 hour moving average, back up here, squeeze all the way to the upside, and go to the other way. It would be the equivalent of this failure up here. Failed up here, move all the way down and go the other way. Because if you can't go higher, you go lower. If you can't go lower, you go higher. But a funny thing happened on the way to the show here, and that was the market moved to the upside here. By the way, the pound sterling was skyrocketing through here, and we stopped. We stopped against the 100 and 200 hour moving average. You say, telling. So the first thing I'm gonna prognosticate next week is that stay below this area right here, and the bears remain in control. Stay below this area right here, the yellow area, up to the 100 and 200 bar moving average, and the bears remain in control. Move above that area, and we're going higher. Okay, it's a point of deflection or reflection or whatever. It's where the energy is. It's where the market moves higher and lower. That's my thesis, okay, for this report here. And so if we stay below this area right here, where are we going? Well, are we going to stay in this little range right here? Well, if we stay in the range from 128.30 to let's call it 130 even, or 130.12, or 129.12 I should say. So 128.30, 129.12, that's about 82 pips. Oops, 82 pips. If we just stayed in this range right here, that would be unusually low, and that assumes that we go all the way up to here and come back down. That would be unusually low. What would be more normal? Maybe 120 pips, at least 160 pips. Somewhere along those lines, okay, would be something more normal. So if we had a high here at 128.92 and we went 160 pips, that would be 127.92 less 60, that would be 126.60 or thereabouts, where we would go to, if I got that right. 160 pips. That would take us right down to this level right here, to the low going all the way back to October. So you can see that if you know that the market has stays below a ceiling, and we're starting a new week, and the week typically has this amount of pips in it, you can start to gauge where we're going. All right, where we're going. And so going back to that daily chart, what are the next targets on the downside? Well, the next target is the 61.8% retracement of the move up from this 2012 low to 2014 high, and that comes in at 127.86. Well, we're currently at 34, so that's only 14 plus 34, 48 pips away from the current level. So can we get to that level? And the answer is yes. Can we get to the next level right here, which is these lows right here, 1, 2, 3, 4, and the low level came in at 127.49. Well, that's 49 plus 34. That's 84 pips from the current level away. Can we get to that level? And the answer is yes, we can get to that level. Can we get down to this level right here at 127.660? And we're at, I don't know if I did the math right before, but 126.60 up to 128, that's 140 plus 34 pips. That's 174 pips. That would be a little bit of a stretch to get down to that level from the current level. That would be a pretty good week in what we've been seeing here, but it is something that's doable, okay? And that's what we want to be cognizant of, something that's doable as long as the bears can remain in control. So if we move lower and we move below the 61.8 and we stabilize at 61.8, and then we move below this 50 level and stay below the 50 level or 49 level, then as long as we stay below that level, we have the chance to keep on going. Now, we may not get there. We may only have 130 pip trading range, 140 pip trading range. We'll deal with that down the road. But the important thing is to recognize that we've got a huge ceiling up here, and we're down near the lows. And as long as the price can stay in the red zone and below that level, in that red zone, and work below, we have a chance to continue this trend to the downside, break out of this non-trending range, and move lower. Now, what about the upside, Greg? believe me, my door is open for a rocket up through the top here and moving much higher here as well. If this fails down here, if we find support here and we open up here and we go up above the 100 and 200 bar moving average right here and we get out above the yellow zone, guess what's going to be support after we get above here? This area right here. And I'm going to be telling you, and you can be assured that I'm going to be telling you that once we're above here, as long as we stay above the yellow zone, we're still going. We're going. And we're going higher. We're going to start thinking about 150 pips to the upside from here. And where, or thereabouts. And where can we go from there? So we're at 128.34. What's about 150? What's about 150 pips to the upside? 129.34 plus 50, 184 or 129.84. What if we go 170 pips? We're going to be banging against the 50% retracement of the move up from the low 2012 to 2013. So my wide for the week, with 170 or so pip trading range, is up here or down here. That we're going to be in this type of range. That would be a little bit stronger, but not abnormal. And that's what I'm looking for in the euro versus US dollar. And that's why I'm looking for some movement in the euro versus US dollar. And that's why I'm going to tell you that it's better to be prepared than ill prepared. And if it doesn't happen, it doesn't happen. No love loss, all right? But if it does happen, you're going to benefit from it because of it. We'll see how it all pans out. My name is Greg Michalowski for ForexLive.com. If you like this video and want to see more of them, make sure that you click on the subscribe button right here on our YouTube channel. Otherwise, please visit us daily at ForexLive.com, where you can get all your information about the foreign exchange market. And it's good, guarantee you. Good fortune with your trading, everybody. Have a great weekend. Bye-bye now.